Good morning. I'm your lead market correspondent for RipplEffekt. We're tracking Denver today, a metro where nearly 1,400 housing starts are underway, where capital deployment remains disciplined, and where rate sensitivity continues to shape every investment decision. The mile-high city sits at a critical inflection point. Mortgage rates holding above 6.8%. Employment steady. And inflation, while moderating, still signals caution for institutional buyers. Let's break down what the numbers tell us. Denver's commercial real estate environment reflects a broader national pattern, measured recovery tempered by persistent rate headwinds. The 30-year mortgage rate sits at 6.82%, elevated by historical standards, but pricing in a federal funds rate of 5.33% that remains restrictive by design. That spread matters. It matters for acquisition costs. It matters for debt service coverage ratios. It matters for underwriting. Housing starts at 1,380 units. Signal builders are still moving forward. They're not frozen. But they're not euphoric either. They're calibrated. The unemployment rate of 3.7% tells us the labor market retains resilience. People are employed. Let's isolate the data points that matter most for your portfolio decisions. Mortgage rates at 6.82%. This is an estimate based on recent market conditions, but it's the rate that's pricing deals today. If you're evaluating a stabilized asset with fixed-rate debt, you need to factor in refinance risk if that rate moves. It won't. The Fed funds rate at 5.33%, also an estimate, reflects current policy stance. There's no near-term pivot expected. That rate anchors everything else. Housing starts at 1,380. Again, an estimate for the year. But the direction matters. Builders are deploying capital. They're starting projects. They're not hoarding. What's the trend we're watching in Denver right now? 3 things. First, capital selectivity. Investors are no longer assuming that every asset in a growing metro will perform. They're differentiating. Prime locations, strong tenant rosters, long lease terms, these assets are trading. Secondary locations, single tenants, near-term lease expirations, these are struggling to find buyers. That bifurcation is widening. Second, debt structure matters more than it has in years. Fixed-rate debt is valuable. Floating-rate exposure is becoming a negotiating point. Borrowers are factual about refinance dates. Everyone's running stress tests. No one's assuming rates fall. RipplEffekt tracks Denver's commercial real estate market daily. We monitor every metric you've just heard: mortgage rates, Fed funds, unemployment, inflation, housing starts, and we connect them to specific acquisition opportunities. Our intelligence briefs give you the context you need to move decisively in this environment. We analyze market cycles. We stress test assumptions. We identify where capital wins and where it doesn't. If you're evaluating Denver properties, or if you're building a Mountain West strategy, our team is here to give you edge. We don't speculate. We don't hype cycles. Visit us at RipplEffekt.com for the full intelligence brief.